personal income, spending, and all the inflation data embedded for the month of December, and the employment cost index, fourth quarter, up 1%. That's eased back a bit. We're expecting 1.2 sequentially. That follows 1.3. Personal income for December, a bit lighted, up 0.3. We're expecting up 0.5. Sequentially, that's following, at least up till now, an unrevised up 0.4. If we look at spending, it's down 0.6, down 0.6 as expected, and not a good number. If you look in the rearview mirror, we were up 0.6 last time. The month before, for October, we were up 0.7. That was a very powerful number. 0.7 was one of the best numbers going back to, well, about 14, 15 years. And if we look at the deflator, here's the important data now. The deflator month over month up 0.4 as expected. The year over year number, that's up 5.8. 5.8. So that takes out 5.7 and 5.8%. Well, that is the highest since 1982. And if we look at month over month, PCE core deflator, that's up exactly as expected, up 0.5. The year-over-year number, and these are what really get hot. So the personal consumption core deflator year-over-year, that's up 4.9%, 4.9%, and that indeed is hotter than expected. It follows 4.7. The last time we were up at 4.9%, well, to find a higher number, you have to go back to September of 1983, as the Wayback Machine just showed me. So we continue to see that the pressures build with regard to many of the year-over-year comparisons. Yesterday's GDP was a powerful number, but it was really promoted by much of the inventory build, which is not a bad thing. We need to rebuild inventories, but it also had to be scaled back from a much bigger nominal GDP due to the pricing pressures. So we continue to monitor those. And as we look towards interest rates, we see week-over-week levels are higher, day-over-day levels are higher, 184 on a 10-year note. We want to continue to monitor as we're potentially flirting with the highest yield close for 2022. Andrew, back to you.
Thank you, Rickster. Have a great weekend. I want to bring in Steve Leisman now, who's also looking through these numbers. Steve, what do you think?
There is two pieces of good news here. I just want to say good news with quotes around it. The employment cost index, which is followed by the Fed, 1% versus the 1.2% that was expected and the 1.3% in the prior quarter. I'm not saying that stuff's coming down. It's just maybe not rising as fast as had been expected. The core PCE at 4.9 was higher than expected. What I'm interested here, Andrew, this is maybe the first piece of data in the new Fed regime here, which is there's no guidance anymore. We're taking this piece by piece. We're going to reset. And I don't know if Rick's still there, but one of the big stories this morning is the dollar was flying. It was up over 97. The 210 spread was crashing. There's all kinds of stuff going on out there. And then, I have my idea out there, which is probably a terrible day to be talking about it, the idea that perhaps there's a soft landing. Is Rick there, guys? I don't know if he wants to come in and tell us what's happening with the dollar and Rick, you and I have been talking offline about this 210 spread and what it means and what it doesn't mean for the outlook for the economy.
I think a soft landing is definitely possible because I still think that we forget a couple of things, that there's still lots of money sloshing around the globe. Remember, about 2 o'clock every afternoon, we learn about that parking lot of reverse repos, which is hovering around $1.5 trillion. There is plenty of capital in the world. The soft landing is more about finesse for the Federal Reserve, and I really do, and I will continue to say that we're experiencing all this volatility because we are anxiously awaiting what we expect. We expect to get a bit of a punch as they remove stimulus. And here we are waiting for it, but we have to wait months for it. This is the volatility, the very volatility the Fed's trying to protect us from, we're experiencing because of some of these delays. They should just get on with it. I think the dollar's a huge positive, And the fact that it is flying at probably about, 16-month highs, maybe more now that it's above 97, is sustainably, these are very good things. And the dollar index is textbook here. As rates are beginning to rise, it's doing better. The fly in the ointment, and Steve has talked about it, I've talked about it, we don't want the yield curve to get a little snaky on us. If it looks like 3 months to 10-year or various parts of the curve start to invert, it immediately leads to the R word. And, that's what it's all about. The Fed and central banks need to try to tighten to a point to control inflation without strangling off the economy. And there's your soft landing. It isn't going to be easy. But what I'd like to make sure to remind everybody is we are not alone. Whether it's the UK, the Bank of England, Bank of Canada, many central banks are embarking on very similar paths.
Shepard Smith here. Thanks for watching CNBC on YouTube.